Good evening and welcome to the FITT Show. Financial information for today and tomorrow. I'm Bobby P. Kinzer,
And I'm Thomas Doty.
and we are the FITT Show, helping our people get their finances in shape. How are you doing today, Doty?
Life is good, my brother. Life
That
is
is
good.
very good, and I hope it stays that way. Getting there is no problem. Maintaining is the key.
Got that right.
Dope. Last week's show, we had a mid-year checkup for 2023, and we hope you all did your mid-year checkup for your particular financial situations, and hope that that show was very helpful to you. So this week, we're going to be talking about the secret of the 1%. And I know a lot of y'all want to know what that secret is, and we're going to discuss that today. But before we get into that, we want you to make sure you actually click on the like button many times you can. It helps give us traction to reach out to the people out there, and the algorithms help us expand our audience. Also, if you on that's if you on Facebook Live. Now, if you on YouTube, we'd like for you to subscribe to our channel, the FITT Show, FITT, capital letters show, and that would help us tremendously. And always, we like to make this interactive, and the best way we can make this interactive if you put comments in the comment box. And actually, that gives us even more traction when you put comments in there. Tell us how we're doing. Ask us questions. Give us your opinion on some of the things we're talking about. And if you have some thoughts or ideas or some other shows, we'd love for you to put that in the comment box also, because that will help us tremendously. Just want to remind you all that we're not selling any products, okay? We're just trying to provide information for people, because, they always say, you only know what you know, and you don't know what you don't know. So that's what our show is trying to do. We're trying to provide a platform to, as the old saying, go put it where the ghost can get it. We try to make it as simple as we can, and just some instances it's not like that, right? Sometimes we gotta put it out there the way it is. And me and Doty, we try our best to give you, the best information that is applicable to your real life situations. That's one of our major goals. We're not just giving some highfalutin information. We want you to be able to apply this to your everyday life, to your everyday situations. And we hope we do that. So with that, I want to say hello to all the people that are joining us. Everybody's jumping online, Dope. We always love that. But let's start, Dope, with the top of our show, the main that everybody's always excited to know about, the stock market.
Yes, Mr. Kinzer, it has been crazy. It has been crazy. At first, when the Fed announced that 0.25 increase, things were kind of not much happened. Because I think that was Wednesday, or maybe Tuesday. Was it Tuesday they announced? Or whenever it was pretty.
No, it was Wednesday.
Yeah, okay, yeah. It didn't much happen at first, and again, that increase has raised their benchmark rate to its highest level in 22 years. So it is kind of high. And so, but then today, I think Japan did something in their economy, talking about a change they're going to make, and that kind of spooked the market. But all in all, not really much happened. And from week to week, if you look at the results, the Dow is only up 57 points, Nasdaq's down 13 points. Microsoft has taken a big hit, and they announced earnings. This one is kind of interesting because they announced earnings, and their numbers beat all the estimates. They were very, very positive, but they kind of put out there how much money they are spending to make this move with AI. And it's billions of dollars that all of the big players are spending. And so that kind of spooked the market a little bit. So it's kind of taken a hit, but their numbers are still good. Tesla stock also is down slightly. A little news came out about them. We mentioned a couple of shows ago that Tesla had uh, come to an agreement with some other companies to let them use their charging system. Well, the companies who didn't sign on with Tesla formed another little conglomerate, and they are going to create a separate charging network. I don't think they like the idea of Tesla dominating that market and pretty much creating another real good way to make some money for them. So it's about 7 other companies that are getting together and going to work on improving the number of charging stations and also trying to make them more reliable, because a lot of people complain when they pull into a charging station. Sometimes the thing is broke, it doesn't work, there's a long line. There's a bunch of reasons which all creates that range anxiety that they feel is keeping people from buying, even more people from buying electric vehicles.
So,
Apple.
before you go off of Tesla, I get this question all the time, and it's not a right or wrong question, but I like to know your opinion on it. So, with Tesla, what is your opinion on it? Buy the car or buy the stock?
Oh,
Or both.
I wouldn't buy the car yet, and only because I drive a lot outside of Charlotte. I go to Cleveland, I go see my kids up in DC, Philly, Jersey, and New York, and I just don't want to be in the middle of West Virginia and can't find a gas, a charging station. Even though I hear that's less of a concern with Tesla, and I don't like. I'm an impatient kind of guy. I don't like the time it takes to recharge. I just get buying gas is easy right now, and so for me, it's a mental block. But if I wanted to buy a car just for local, I, then it's not an issue because the car charges overnight in your own house for free. And so from that aspect, I think it's as a car, it's great. As a stock, I think it's also a good play only because, and that's why I own it, only because they got a bunch of ways they make money. Right now, they're the top player in the EV market, even though everybody else is catching up. And they got a lot of ways to make money, and they're always in the forefront. And so, yeah, I think it's a good play. That's the reason I own it, you know?
Yeah, just wanted to know your perspective.
Yeah. Now, Apple has hung in. And and one more thing back to Microsoft, it's down to 331, but everybody is still, when I say everybody, a lot of the analysts are still bullish on it. And if I didn't own so much, I'd buy some more. That's how I feel about Microsoft.
Right.
But Apple's hung tight. Pfizer's dropped a little bit, and Nvidia is still on the move. It's up to 459, and that's the one Bob I bought at 171. So it's I'm waiting for that to be up 3 times. Then I may figure out if I want to sell it or not. And the other thing I just bought some Google, and only because it dipped to 117. It dropped to 117 maybe a couple of weeks ago, and that's the one I don't see why more people are jumping on, only because all the numbers they're putting out, they don't even have the NFL ticket, which they just took from DirecTV. That's not even in their numbers yet. And I think that's going to bring a lot of money to them. YouTube, they're making a lot of money off YouTube. And I got in at Google at 117. It's up to like 129.8, almost 130.
So is it Google's stock symbol called Alphabet?
Alphabet, that's the name of the company, yeah. But the symbol is GOOG. To me, it'll always be Google. But that's another one I think is a good play. But again, those are stocks that fit my own personal situation. And one thing I want to talk about with this interest rates, it's kind of funny because you have two very, very different opinions as to what should happen next. And it's just like in war, you have the hawks and the doves. You have the same thing when it comes to whether or not the Fed should continue to raise their interest rates. And the doves are saying, okay, we've done it enough. We don't want to push the economy into a recession. We probably don't need any more increases. inflation is only slightly above the 3%. I'm sorry, the 2% target that the Fed is trying to reach. And the problem with that, and the Hawks are very clear to point this out, that if you look at core inflation, which takes out food and fuel, and those two things are very, very volatile. If you take those things out, and what's left is called real inflation, it's about 5%. And the big thing the Hawks are worried about is the fact that the unemployment numbers aren't changing that much. And so they feel that that 5% real inflation number in their eyes is not going to be any different in September when the Fed meets again and decides whether or not to change their interest rates. And so they're saying we definitely need more interest rates. And their concern is not so much recession, but is to stop this cycle of continuous price increases, because they say that it's kind of becomes self-fulfilling, and we could run into a situation like we had in the 70s, where inflation was going crazy and it lasted for a long time and it did a lot of damage. So the Fed hasn't let on as to what they're going to do, obviously, because it's 2 months down the road. And I think some more data comes out between them. They'll have a lot more information in a couple of months and figure out what they're going to do. But it's going to be a wild ride for a while until things settle down. And I don't think they're going to be settled down for a good little while. So the next time the Fed meets in September, so we'll have another conversation about that then.
Well, though, I just want to make a few points. The NASDAQ is at 14,000. And when Obama went out of office, when the markets were doing great, it was at 16,000. And so it's coming back. It's really interesting to see it come back to where it is right now. And nobody knows. Another thing I wanted to point out, though, that NXP semiconductor stock that I have is weird because it seemed like it's tracking with NVIDIA, who is its competitor. NVIDIA is much bigger. I got in at $90 and now it's at $221. But I'm noticing each day when NVIDIA goes up, it goes up too. So that's been interesting about that particular stock. And the other one, though, gold has been just trickling along. Normally in an inflationary environment, gold does very good, but it had gotten over $2,000. Is that right? Yeah, $2,000 an ounce. But now it went down under that and it's heading back towards that. And there's a lot of advisors out there that starting to talk a little bit more about gold. I don't know what's going on, but it's been a lot of talk in the market about gold. But it's been trickling along, $2, $5. But at one time it was going up $25, within a week. So just wanted to mention that about commodities, because sometimes, a lot of times, we don't talk about commodities. All right, though, let's talk about my favorite subject, which is cryptocurrency. The cryptocurrency market is down by 22 billion. Now, it's still at $1 trillion, the market cap. People are still in it, but a lot of people are taking a lot of profit off the table. Now, the Bitcoin was like really rolling there for a couple of weeks, though, like over $1,000 a Bitcoin that it was going up. This week, as the last week, it was down, and this week is down $620 per Bitcoin. It's down from $29,806 to $29,186, 2% drop, and that's sort of what the market has been doing. It's been following the market. Though every time I get ready to take off Shiba Inu, it's done. It's I don't know. It's such a dog. Literally, the meme is a dog. But it went from 18 spot up to 17 every time I get ready to take it off, and it's trickling. It's weird. But and then the Dogecoin is staying flat. I mean, it's not really flat. It's been going up, very small increments, but it's been going up. So that's the cryptocurrency market, though. As we say, it's so speculative. Nobody knows what that market is going to do. But all I can say for myself, though, I'm holding on, man.
It's going to get ugly. I mean, they just a lot of the pandemic related lifelines that were thrown out to people are going away. The student loan thing that people were waiting on obviously went away, and then you have a lot of payments that are starting. People got to start making payments on student loans. So I'm not sure things aren't going to get worse before they get better, but we will see.
Yeah, the student loan situation, Biden has got another plan, though, to give relief of $39 billion to income driven um, student loan payments that are based on income driven. And that's going to reach about 800,000 people. So he's still trying to, squeeze in there and work around, Congress and the Supreme Court to try to help people with that student loan debt. So that's always good. So let's get into our topic. A lot of people want to know, what is the secret of the 1%?
Yeah, and let's give a little background on that. In 1989, the top 1% of households in the United States, they control a little less than 23% of the wealth in this country. That's 1989. Well, now that number is up to 32%. The bottom 90% have seen their share of wealth drop from 40% in 1989 down to 31%. And so everybody talks about the wealthiest, that 1% is the wealthiest people in America. And a lot of people say this inequality is based on things the government has done, uh, things that they have secret, smart financial advisors, or maybe they inherited the money, and that's true. You can find examples of all of those. But there's also an investment component, and that's what we're going to talk about. And a lot of people, again, they think you got to be smart to invest. You have to have a financial advisor who gives you great stock picks, and none of that is true. But we're going to look at how that 1% allocate their assets, and it will kind of show there's a simpler path to their wealth. And that's why we're going to discuss why that 1% wealth gap is growing.
And it's interesting, though, because some people probably wonder why we're picking the 1%. Well, they are the wealthiest, but there's this myth that they're like so much greater intellect. But, the United States has approximately 335 million people, though, and that's in 160 million households. That's reviewed by IRS. So that means that 1.6 million households fall into the 1% of the wealthy category. Now, there are a variety of reasons for the disparity, like you said. But one important factor, though, is outsized stock ownership among the richest Americans. The 1% own more than 50% of the equity shares in both private and public companies. Much of their wealth comes from soaring stock prices. I want to show a chart that shows that, though, which is pretty interesting to see how much that 1% owns in the market. So if you see here, this says the top 1% owns more than half of the stocks in the United States. So the top 1% owns $19.2 trillion of stocks. That's 53.5% share of the stock market. And then you take the top 10%, the 90 to 99%, they own over 12 trillion. That's 35%. That means the top 10%, though, owns about 90% of the stocks in the stock market. What does that tell people, though? What do you think that that message could be? Because look at the bottom 50%. They own 200. I can't believe that, though. That's 200 billion. That's pretty low. They own 0.6% of the stocks in the stock market.
Right.
I mean, that's we're going to talk about this because that should tell you something. There's a message in there somewhere, though.
Yeah.
Now,
Oh, go ahead. I'm sorry.
no, go ahead.
No, and that's the thing that the rich has definitely gotten richer, and you know, a handful of investors, again, like they may have invested or been lucky, but again, if we look at how they allocate their resources, their assets, it'll give you an idea of an easy way to get to wealth. And it's easy to say that, and it's true, that the rules of the game, especially tax wise,
Right.
are
Yeah.
geared toward tax ownership or stock ownership.
Right.
You know, you just that's how that those are the rules. And if you ever want to be effective playing a game, you have to understand the rules and use the rules to your advantage in order to be successful. And uh, another slide, show the slide that shows that what the top 10% hold as far as wealth. Okay.
Okay. I'm gonna get to that. Let me wait a minute. Oh, let me. That was coming up, and that's the top 10%, right?
Yeah, top 10%. And yeah, what percent of the wealth they hold. Yeah,
Yeah. Go ahead.
yeah, and it's crazy when you look at this. You just take a minute to look at these numbers, and it's obvious where the wealth is concentrated. You know, if you look from the top 90%, 90 and up, that's where most of the money is. I mean, that's pretty much where it is. So, you know, we in a previous show we talked about not trying to keep up with the Joneses, but in this case, you want to try to find out what are they doing to continue to build wealth, and what can you learn from them in order to maybe pick something up from what they're doing and kind of help your situation. And when we saw this article in Fortune, we jumped on it and said, "Yeah, we got to talk about this because this, to me, that it shows what you should be doing." And so, if it's even trickier when you look at assets and liabilities, you can see why the top 10% controls 70% of the assets. The bottom 90% holds 75% of the debt. Okay, that's that next slide, Bob. Can you show that one? Yeah. I mean, you take a look at that, all the liabilities. So they don't have a lot of liabilities, but they have a lot of assets. Okay. And so again, that we're just saying what can you glean from this information? And I think that's the point we're trying to get across.
Because
That
look at that. I mean, 90% owns 30% of the assets, but 75% own the debt. So if you look at that right column, the liabilities, 50 to 90%, yeah, 50 to 90% of people have 43%. In the bottom 50% has 32. So that's 75%, like it says, of the debt. Why the richest people own 90 or 30%. God, that's
we always talk about how once you start investing and the money grows and rule of 72s and the money doubles and all this stuff, it works the other way with debt. Okay, when you have debt grows usually at a faster rate than the assets because usually the interest rate is higher and is fixed. Like we always use the 9%, which is about the average of what the S&P has done over the last, I don't know, 100 years. But most of the debt is at like 18% and up. And so there's a compounding factor to that. And so when you compare they got assets that are growing, and
We have debt. The
the debt
Lord has
is
debt that
growing.
is growing.
It's growing faster.
Right.
It's growing faster. So
And thus the wealth gap.
exactly,
That explains the
that's
wealth
why it's
gap.
getting bigger.
Yeah, but the thing is, why we focusing on this 1% is because they're not doing anything that is like over the top asset manager. I mean, now most of their wealth comes from soaring stock prices, but no, that of course can leave them vulnerable to declines in the stock market prices. But they may get even richer if they take some of those stock gains and what they do, reinvest the money in investments that cater to rich investors, like hedge funds, private equity ventures. They take the money that they take a little bit of risk and then they reinvest it in other things. So the wealth gap must be close. Now, the wealth gap must be closed from the bottom up, right? That's
Right.
what I believe, though, by bolstering two of the three ingredients of the middle class wealth. That's owner occupied homes. Still, I mean, even in the Bush administration, though, he was pushing everybody, you get a house, you get a home, you get a home. And how did that work out with people? But still, owning a home, though, is still leading to, um, um, closing the gap to wealth. But the other one represents the majority of the households' wealth for most people. And in 2019, the survey showed that most of the people's wealth is their house. But financial assets is the other key ingredient, such as stocks, whose value measured by the Dow Jones Industrial Average increased sevenfold, though, since 1989. 7 out of 10 Americans in the wealthiest 10% had at least a bachelor's degree, according to the Federal Reserve, but only 1 out of 5 members of the least wealthiest half of society does. Now, is there any parallel there with education and earning money? I mean, that's what the statistics are saying. I mean, it's not saying that's the only way to be able to earn money, but there's definitely disparity in people who have college degrees, which I've showed those scales before. When you have a bachelor's degree compared to just a high school diploma, you make about maybe $40,000, $50,000 more. But much more could be done to give the poor half, or not the poor, the lesser half of American population stakes in the nation's growth and prosperity. And that's what we're going to talk about today.
Okay. And yeah, and that's the thing when we look at stocks. Okay, that's the asset class that has the highest the highest long-term returns. And so it's crazy when you look at, I think I said before, the stock market is average between 8 and 9%. And we've talked about before how if you look at bull markets versus bear markets, there's always been more bull markets. We talked about how after a recession or a bear market, how stock market always goes crazy. And if you had your money in a checking account and a savings account, and you look at the paltry returns that you received, it's criminal when you compare to what you could have done if you had that money invested in some sort of equity. And the extreme case, or the worst case yet, is if you weren't saving any money at all, then you're definitely going backwards. You're definitely going backwards.
Yes. So the rich keeps getting richer, correct?
Yep.
So I mean, and these slides actually show it. I just want to pull up these slides again um, to prove that information, though. So stocks are the asset class
Yeah.
that historically, though, has the highest long-term returns. No doubt about it. So it makes sense that the gap between the haves and the have-nots have grown. Now, stock market, like you said, average between 8 and 10% over the past few years. Way more, and there's been way more bull markets than bear markets. And after every bear market, and even after every recession, there's always followed strong growth. I know people get worried about the risks and being in the market, but compare those returns if you had your money in a checking or savings account.
Hey, hey, Bob, do you think it's fear? Do you think it's fear of the stock market or ignorance of the stock market?
I think it's both. I think it is both. There's no question when people, and it's amazing we did this before, the mindset. It's amazing they say when there's losses, people tend to focus way more on losses than on gains. And it just paralyzes people to make moves. But the other side to your question, though, is it's definitely, I believe, the education of the market. That's why we're trying to share this today on the 1%. It's not because it has been inherited. It's not because they had inside trading information or things like that. It's just that they had the information and they see the consistency. We always talk about it. The more you stay consistent with the market, it'll it'll turn around. And I mean, it could be the only thing worse than your money just being a savings account. You're not going to become wealthy with your money in a savings account. The only thing worse than just having your money in a savings account if you're just spending it frivolously. People miss that though. People really miss that. The biggest problem with people and their finances and this wealth gap is I talked to you before about the book, the Millionaire Next Door. The average millionaire has an old car, 6 years or older, where the average middle class person might buy a car every 3 years, a new car every 3 years. The average, millionaire, they say, have a suit like that $300. I know people that got 3, 4, 5 suits that are $1,500 in their closet, you know, buying, $300, $500 watches, where an average person just has a regular old watch. But I think it's no question, though, the disparities in social economics is a play too, social economic equity, because we don't have a lot of access to a lot of the wealth or the opportunity to gain wealth. But it is also our habits, our spending habits are terrible.
Yeah. Okay. We got another slide I want to show. That's slide 6, Bob. Things are, and it shows that things are far more equal when it comes to the housing market. And in the bottom 90% by wealth, they only hold 11% of the stock market, but they control 56% of the housing market. And the bottom 50% own less than 1% of the stock market, but nearly 12% of the housing market. And this explains why the liabilities for the bottom 90 are so much higher, since most of their households have mortgage debts to repay. And so you can get a better sense of the difference between the various wealth percentiles by looking at their allocation of stocks and housing relative to their total assets. And that's what this shows you. And that's where it gets, the top 1%, they also have a higher share in things like cash, bonds, and private business. But you can see from the chart that most of their wealth is invested in the market, while housing is by far the biggest asset for those in the bottom 90%. So what can we learn about investing, like the 1%, when it comes to how they allocate their assets? That's a question. Mr. Kinzer?
Well, what we can learn is that the stock market is an alternative. That's what we learn, that I mean, they're heavily in the stock market, though. I mean, and it's not like we trying to tell people to, mortgage your car and, I mean, mortgage your house and go change your car in and just jump into the stock market. No, no, we always talk about diversified portfolio. So what we're saying is, if you have a financial plan and you're building a portfolio, you should have stocks in that portfolio because that's what is coming out showing that one of the secrets of the top 1%, though, they're heavily, their earnings have come from the stock market. And let me tell you another little secret, though, that is done by the top 1%. And people don't understand. When you have money in the stock market and it's growing, it is not taxed. It's called unrealized gains. Until you take it out, it's not taxed. So like Mitt Romney, they were talking about when Mitt Romney was running, he had over $14 million in unrealized gains. So they make out on the tax thing too because they don't take it out and they're not taxed on it. So that's another thing to learn about why holding stocks are good because they're not taxed until you take the money out. It's called
Yeah,
unrealized gains. I mean, they've been playing that game for years, though.
yeah. And the other thing, Bob, I think it tells you, you don't want to concentrate your investments, right? You don't want to put
Right.
all of your money into housing. Maybe you buy a little less house and invest a little bit more.
What's that
Okay.
term, though, called house poor? You heard that
Yeah,
term?
yeah, but yes, and you mentioned the key word there, diversifying. The bottom 90% has most of their wealth in a single asset, their home.
Right.
1%, they're more balanced. A house is probably going to be the biggest assets for everybody, but maybe you don't put as much into a house and you put some more money into other assets like stocks and bonds.
And Joe, this comes back to the knowledge thing too, because it's weird how we tend to emulate, you know, other people like the young people emulate the hip hop people with, the styles, wearing Louis Vuitton and wearing Gucci and name brand. And we emulate those things, but we don't emulate the things that will help us gain appreciating assets. And that's why we want, why we have this topic, looking at the top 1%. It's just, it just makes a lot of sense, though. So go ahead.
Now, and we've talked about debt negatively all the time, but even for myself, Bob, and I know this intuitively, I know this, but it smacked me in the face when you think that debt compounds against your net worth, just like stock returns compound in your favor. And that kind of, when you say that or think that to yourself, it can make you, afraid of debt because it does compound, and it's a negative component. The more you have, the more negative it is, and I think that's how we need to look at. You need to look at debt as a very, very negative. Now, most people have to have a mortgage to buy the house, but again, maybe you don't buy as much house, and you take some of that extra money and invest it. But when you think of the fact that something negative and the way it compounds versus how we always brag about how compound interest works and how it doubles every, depending on the rule of 72s. If you're getting an average of 9%, it doubles every 8 years. Well, if you're paying 18% interest, it doubles every 4 years. Okay, and you think about that. If you're carrying credit card debt, that debt doubles every 4 years. And so,
So help me with this, right? We have a lot of people on here that are close to retirement or either retired, been retired. How does this translate to them? How does this information? Because some people say, "Whoa!" Like I had a cousin last weekend tell me, Bob, he has a painting company, he has workers painting houses. he said, I watch the shows, but I get to the point where I turn it off because it gets over my head, or I don't have no money to invest. I'm like, but you have money coming in from a painting company, and so let me go back to the question though, because he's older and he's like, ooh, I passed that investing in the stock market. I'm too late. And there's people who retire to think, why would they put money into the stock market now? Can you talk
Well,
to that?
it's tough to answer that because again, it's hard to give advice. We're talking in generalities.
Correct.
We're not talking about anybody's specific situation, and that's why it's important when we talk about these things. We're just encouraging people to invest, and no matter how much you have to invest, you invest something. We always, that's one of the things we say. We probably said 100 times. You pay yourself first, and you work backwards as far as how you handle what's left. And that's going to drive you to live within your means if you pay yourself first. And so it's hard to say what, again, you have to know somebody's entire situation to say how they should handle, you know, a particular money situation. But the thing we can say that's true, it's proven, not guaranteeing it's going to happen in the future, but the stock market has averaged between 8 and 10% for the last 90 years. And if you've had money invested in the stock market, you probably built some wealth. And now people could say, before you could say, well, I only have $100 a month to invest. And it used to be that way 20, 30 years ago, where you could only buy stocks in, certain lots.
Yeah, certain lots, 10
Yeah,
lots.
but now you can buy $100 worth of stocks anytime you want. You can buy $50 or 25. You can buy mutual funds. You can buy individual shares of stock. You can buy a percentage of a share of Microsoft or Google or whatever stock that you're interested in. So there's really no excuse for not being able to invest in equities. And again, it's not for everybody. If you don't want any risk, the stock market's not for you. But you got to accept the fact that your returns are going to be very, very low. And you can take the chance of outliving your money if all your money is in a checking account.
And that's the point where I was, going though, because like you said, we don't. Everybody's individual situation is unique to them. But one of the things why I raised that question is because if inflation keeps going at the pace it's going, it eats at your savings. If you're getting 2%,
It don't eat at, Bob. It eats up.
it eats it up. And that's one of the points I wanted to make when although you may be in retirement and you may be sitting on, got some money in your safe at home, and if it's not earning anything, or if you got it in a savings account, just think if you're making 2% in a savings account, up from what it was 2 years ago when it was less than 1%, you can say, oh, let's say 3%. Inflation, like Dote said, core inflation is 5%. Guess what? You 2% in the hole. Your money is losing value. That's why you got to think about increasing your assets, getting appreciating assets, because you can wake up and, like I've always given this scenario though, if last year a pack of gum was $1 and you kept your dollar under your pillow, and this year you wanted to get a pack of gum and the gum is now, because inflation, $1.50, guess what? Your dollar didn't grow, you would not be able to get any gum. And that's why I bring up this scenario. Like you said, though, everybody's situation is unique to them, but you need to think about making sure that you have money to live on. Because what, though? The actuary tables are showing that men and women are living longer. The actuary tables are like 85 and 86 now for men and women.
Yeah,
Back in the day, they were judging around about 70, 75 was your retirement plan. So if you're living longer and you want to live, a nice little lifestyle, you really need to consider, ways that you can grow your portfolio. That's all I wanted to say, though. So, though, the other thing that the secret of 1%, they don't go into a lot of debt. That's a big one. They do not go into a lot of debt. There are good and bad forms of debt. We've always talked about that. Like a house, that's good debt because you got equity, it's growing. Most of us need to utilize our mortgage debt because not many people have that much money lying around in cash. But it's important to note that debt compounds against your net worth, which you said before, though. So, these returns compound. Stock returns compounds in your favor. So it leads you to buying stocks, though. And it's not the only thing, but not everyone has the ability to own their own business. But I hope people do realize that risk, though, I found that so many people do not invest in the market because of the risk. And let me tell you the other reason, though, surveys show, and this is strange, it says the people's patience. People who do not have patience to put their money and let it sit there, like you said, the rule of 72 to double in 5 years. And that's been another one, though. Patience be killing people because they don't want to wait and take the time, because that instant gratification be eating them alive. But anyway, that's why we wanted to talk and discuss with you all day the secret of the 1%.
Yeah, I mean, the stock market is the simplest way to build wealth over the long term.
It's not the only way.
Yeah, but it's the simplest way. And you look at some of these corporations that are growing like crazy. And again, it takes some research to find the right company, whether you want to invest in Microsoft or Google or NVIDIA or MPX, as Bob has, or Ford or whatever. You do your research, and you can build wealth by riding on the coattails of these big companies and some of the best companies in the world. And that's the simplest way to build wealth.
Yeah,
Simplest.
and the thing is so many. I mean, like you talk about the individual stock, and then there's index funds. The index funds are managed by money managers. They call it passive management. You don't even have to worry about it. They manage it according to the market. There's so many ways to go, though. Mutual funds, ETFs, exchange traded funds, IRAs, Roth IRAs. So like it's not just one way that you can get in the market. Nowadays there's so many different ways. Like I said, commodities, there's gold out there if you want to. And a lot of people got all this jewelry. Guess what? That gold you got in the boxes are worth something. That's why they used to talk about the young boys in the hip hop era in the 80s, though, wearing all the big chains. But they're like, wait a minute, they got more appreciated asset than the middle class people who will buy Mercedes Benz and their car losing value. So we hope this was helpful and using the 1%. So, Dope, let's go to the summary and takeaways for tonight. And they should be some good ones.
Yeah, and the first one is kind of what this whole show was about. The rich are getting richer. And I mentioned before, they have a very good understanding of the rules, and they take advantage of the rules. And I don't care what game you're playing, if you're not taking advantage of the rules, you are probably not going to do well. And so that's why the rich are getting richer.
So the next one I talked a little bit about emulating success, right? Because some people say, oh man, you should emulate the Koreans, or you should emulate, the Jewish people. You should emulate. Man, we need to emulate people who are just successful. How about that? And the 1%, I'm telling you, it's so much to learn. That's why we're using this today. That article was so, and we want to give disclaimer that we pulled from a lot of. Was that from
Fortune?
Was that from Kiplinger?
No, Fortune.
That was from Fortune, right? That was from Fortune. And I mean, we emulate so many other things. Why not emulate what they do for success, but we get intimidated because we think they're, successful because they're smarter or they inherit. No, no. Take a look and see what they do, and you'll find out it's some simple things. It's just about being consistent and being able to take a little risk.
The third, don't let fear stop you. And there's two things, two components to that. The first is fear of investing, of the risk involved in investing. And the second is the fear of knowledge and the fear of not of immersing yourself into learning about financial, learning about financial literacy, because it plays such a big part in your life. And don't let fear stop you. Learn about risk, learn about financial literacy, and get on the road to increasing your wealth.
And the last part is what this whole show is all about: the secret of the 1%. And I hope y'all see what that is tonight. That they invest in the stock market. They diversify. They don't put all their eggs in one basket. They don't concentrate their investments into one investment, and they seek knowledge. So I hope that helped y'all tonight. The secret of the 1%. I thought it was pretty cool, that article when me and Doe said, we said, oh man, this is what we talk about all the time, and this is the 1% is doing stuff that we were talking about. And it's like made us like we some geniuses or some stuff but we just using practical and common sense knowledge, man. So with that, I want to thank everybody for tuning in, as you always do. Thank you, Modestine. Modestine said the valuable information to follow to grow wealth. And as we always do, we like to give shout out to all our viewers, both related, non-related, and just friends. Modestine, Mo, you always hanging in there and giving great comments. We thank you. Rodney, the noteexperience.com. Go out there and check them out, y'all, as another alternative for investing, holding mortgage notes. My sister Linda Sy, my sister Gloria, and my sister Nolia. Man, it just feels so good to know that you have family. And guess what our motto is? We are the Kinzer family. If you can't help them, don't hurt them. And that's our motto. We keeping it all about love, man. And my brother, Carl Chapman, hanging in there every week, and he always gives good comments. And when I see him, he appreciates the show. And everybody else out there who I didn't mention you because I can't see you if you're out there on YouTube or you over there on the other FITT Show account, which I was not able to see. Thank you for joining us, and our partners overseas, dope, because it's like 1, 2 in the morning for them. So thank you. So we'll be here next week, same back channel, 8 p.m. Eastern Standard Time on Thursday. Look forward to seeing you next week with another informative and interesting show. Have a good evening.
Peace.
Peace.